and the stat isn't specific to financial advisors, but across all kind of sunsetters in all industries. A year after transition, it's like 70 or 75% of sellers regret selling. And it's not from a financial, man, I didn't get top dollar.
Mm.
It's from, what the heck do I do with my life now? I was
Mhm.
spending 40, 50 hours a week doing this, and now I'm supposed to do the crossword puzzle and fish every day. So there's a lot of planning, both from the business side, but also the personal, that needs to happen prior to a success. So we work with folks kind of holistically and help them plan for something that goes smoother than they anticipated, and they've got a plan for after they retire or move on to the third act.
You're listening to The Uncertainty Edge, the show about the art and science of moving forward when the path isn't clear. I'm your host, Sam Sivarajan. Each episode, I sit down with leaders, advisors, and thinkers to explore how they navigate uncertainty, make better decisions, and stay focused in a world that rarely cooperates. Together, we'll look for the clarity hidden inside uncertainty. Hi, everyone. I'm Sam Sivarajan, and welcome to today's episode of the Uncertainty Edge podcast. Today, I'm joined by Andrew Muroli, co-founder of BuyAUM, a specialized firm that's reimagining how smaller advisory practices can navigate succession planning. With a background spanning alternatives investments and entrepreneurship, Andrew has identified a massive gap in the market. The thousands of solo advisors managing under $250 million who lack viable succession options. Rather than the traditional blast-it-to-everyone approach, Andrew and his team have developed a unique process, methodological, relationship-first approach that's helping advisors transition their life's work in record time. In just 1 year of operation, they've closed deals in as little as 134 days by focusing on what matters most, truly understanding what sellers want and finding the right cultural fit. Andrew, welcome to the show.
And thank you for having me. It's a pleasure to be here.
Looking forward to our conversation.
Yeah,
So,
me too.
Andrew, your journey took you from alternatives investments in Newport Beach to co-founding BuyAUM with a partner you met through a cold call.
Yeah.
Walk us through that evolution and what sparked your recognition that smaller advisory practices needed a different approach to succession planning.
Yeah, so it's the recognition really came as a consequence of just doing normal business and entrepreneurship. I've been working with financial advisors my whole career, which is about 10 years. Moved out to Newport Beach, originally selling alternative investments like REITs. I went into oil and gas. I got into venture, private real estate, all of that stuff. And I saw some of the advisors that I had worked with, and in fact, my father he was an Air Force pilot for 28 years, and at 40 became an advisor and grew a significant practice. And then he was the old bird in the group, younger partners, and he had a solid book that he wanted to transition out, needed a retirement plan. And so they found someone to buy their practice. It took 18 months. It almost split the firm apart. They lost some of their partners or advisors. It was a huge mess. And I saw that and I said, I had been in full-time entrepreneurship for a couple of years. And I was like, there's a better way to do this, right? I love the, I don't know if it's quote or analogy that says like 1% better or 3% better is innovation. And so that was really the genesis of this, is what is the current landscape of M&A within financial advisory practices? And how do we make it just a little bit better? So I got a cold call from who now is probably my best friend. We speak every day for many hours. And he cold called me and he said, the best line I've ever heard. He said, Andrew, I want to be honest with you. It's a cold call. Do you want to hang up or give me 30 seconds? That's pretty good. I'll give you 30 seconds. Right? I make cold calls all day. I haven't heard that. So we started speaking. We ended up having monthly kind of how's life going? Let's talk about business. And that really blossomed into a friendship. And then we saw this gap in the market and said, we're a great team. How do we do this a little bit better?
Cool. Yeah, I've never heard of a cold call line like that as well. You're right. It's kind of intriguing. You know,
You're hooked
tackling the
right away.
elephant
Yeah.
on the table, right? So now you've identified something that is interesting, which is that to 60% of advisors are around 60 or over. In total, across the US and correspondingly in Canada, they're managing trillions of dollars in assets in total. Yet many of them have smaller practices without a viable succession plan. Can you paint a picture of what typically happens to a solo advisor with a, call it a 50 million, 75 million, $100 million practice who has no plan when they're ready to retire?
Sure. Yeah. So it is, I mean, the numbers are really staggering. It is, we'll just say trillions of dollars, but it is, let's call it half of every advisor out there is in the next 10 to 15 years going to be retiring. Now, one thing about this, Sam, is that these guys are not coal miners, right? And so being an advisor at 72 is not the same as digging a ditch. And so there is a longer runway for this. However, most of these gentlemen and ladies are independent advisors or they're a part of a team but most of who we work with are independents. And they do that because it's a lifestyle practice. They work 10 to 50 hours a week, maybe on the high side. It's
Mhm.
not a big scale. And so life is good and the practice is running. And so it's just this thought in the back of their head of what happens if I get hit by a bus? Or I've heard that multiples for these practices are ticking up. I wonder what my practice is worth. It's just me and 100 families that I steward. I got 50, 60, 70 million in assets. I don't really know. And that's what we find a lot is that when we first engage with the sunsetter, it's more of a Q&A session. What's going on in the market? How should I do this? How should I think about it? But what typically happens is without someone like us, they maybe get to the point where they finally say, okay, I've had enough. I'm tired of the market or I'm tired of my clients or audits. I want to transition. We've got a guy that we're working with that just breached the 100 million mark. So now he's going to be SEC registered. He's like, I've been doing state audits my whole career. I'm not really sure how to go about this. I'd rather join a bigger firm.
Mhm.
There's a countless stories right there, right? But what typically happens is they'll find a marketer or a big aggregator. They'll put their business, they'll have one short call. That person will kind of create a listing almost like Zillow, and then their practice is up for sale. And sometimes clients find out about that, and that can be a whole conversation. Other times they get swamped with offers and they don't even really know what their practice is worth, but now they have 50 IO or LOIs and they're having to sift through that. So it can be a very strenuous process that, again, they're independent. Maybe they have one assistant, maybe two, but no one to really bounce ideas off of. The country club multiple often is in their brain of, I heard this guy got 6 times revenue. I should get that. There's just really a lack of information and knowledge because while there are tens of thousands of advisors, they're very silent. And so it's not this intense community where you're talking about this or that. That's more of the rare case. So often it is, imagine the first time you tried to buy a house, maybe years ago, you didn't know what you're looking for, right? You get 100 offers for a lender closing. I mean, it's just this unknown. And so a lot of times mistakes are made that I'm a certified CPO, which is a certified exit planning advisor. And this isn't, the stat isn't specific to financial advisors, but across all kind of sunsetters in all industries. A year after transition, it's like 70 or 75% of sellers regret selling. And it's not from a financial, man, I didn't get top dollar.
Mm.
It's what the heck do I do with my life now? I was
Mhm.
spending 40, 50 hours a week doing this, and now I'm supposed to do the crossword puzzle and fish every day. So there's a lot of planning, both from the business side, but also the personal that needs to happen prior to a success. So we work with folks kind of holistically and help them plan for something that goes smoother than they anticipated, and they've got a plan for after they retire or move on to the third act.
No, I think it's ironic, right? Many financial advisors are working with their clients, helping them do exactly that, right?
Sure.
Or helping them on exit planning for their business, or if they're planning for retirement. The real top advisors are helping those clients sit there and think through the things that you're talking about. How are you going to fill those 50 hours a week that you were spending at work? Who's your friend network that was at work that you were getting, etc.? And it's the old saying that the shoemaker's children, are the ones that often go barefoot, etc. I think the idea of helping support an advisor through this process and getting them to think through these things, I think is very valuable. But let me unpack this a bit. Obviously, as you rightfully point out, this is not a conversation that they're having with a lot of other advisors, because this idea of your selling for the reasons that you talked about, that you don't want others in the industry to know, you don't want your clients to find out, especially if you're early in the stages of exploring what this might look like. What is the market for a smaller practice, etc.? Are there big firms that are looking to, or aggregators that are looking to buy a 50, 60, $70 million practice? Or does it really depend on other factors that make it, whether it determines how much demand there might be for that type of a practice, like location, the demographics, all of those things?
The short answer, Sam, is absolutely. At the end of the day, you're seeing this all trickles down to supply and demand, right? And so the reason that you hear the country club multiple and the value of these practices increasing is that there's a lot of people out there buying them. And it typically, most of the action, these high multiples are happening in the billion, $5 billion, $10 billion ranges. Why? It's because it's safe recurring revenue. If you put your just investor hat on, it's cash flowing from day one. It's very sticky revenue. What a beautiful thing to spend PE money to buy, right? So that trickles down all the way into what we call the lower market, which is sub 200 million, 250. Now we're doing a deal with a guy right now. He's got a broker dealer and a BD, 550 million. It's not like we only work in the lower market. But what we find, Sam, is that the lower market is fairly ignored. I had a conversation with a guy in San Diego. He filled out our true value report to get a free, no strings attached kind of what's the value of your practice. And we had a follow-up call. And he's like, well, that's all great, but I've got 38 million bucks. Is that like, do you even work with people like me? Is that too small? Which is a fair question. But the surprising truth is that a lot, like if you look at not at AUM, but number of advisors, the bulk, 2 standard deviations, the main segment of those advisors are independent and typically have less than 100, 120 million. So that's where the most of the sellers or sunsetters are. And there's not a lot of service or support that goes into that. There's other firms that do great work, are more like investment banking, and they say, unless we can net $1 million on a fee on doing a transaction, we don't touch it. That's got to be a huge practice. And so if we talk about micro improvements to the whole industry that we're looking at, is how can we serve the lower market, because no one's knocking on their door looking to buy their assets. The result is you've got a 72-year-old guy in Dallas, Texas with 15 or 20 million bucks under management, has no plan, has no prospects. He's got something that's of value that people are willing to buy, but there's not that bridge. So there's absolutely a market for it, Sam, because it is that recurring revenue. That being said, not all books are equal. Not all books demand the same revenue multiple. Even $250 million books might be structured. This guy's he's charging 1.75 or even 2% on his fees. This guy's charging 1%. You would think, well, this first one, there's more revenue, so that's a higher value of it. Not necessarily, because as the buyer, hey, I've got a system, I charge a flat 1% fee. I need to normalize those fees down to so there's a lot of nuances to this where advisors have been, again, it's a lifestyle practice, good for them. It's been paying bills and providing for their family for 2, 3, 4 decades. I don't really know what I should do to sell it.
Right.
That's where we help it's like curb appeal, right? You're going to pressure wash your house. You're going to clean the carpets before you put it on the market. At least you should, right? My grandfather would say, when you're buying a car, always check to see if the trunk is clean, because if the trunk's not clean, the person didn't care about the car and you're going to have problems. So a little bit different, but same sort of thing. It's like, how can you improve the value of your practice? It's by doing these little things prior to putting it on the market. But there's absolutely buyers or interest in even the lower markets asset.
Now, let's talk a little bit about the process that I'd mentioned in the intro, that you call it your vision casting process, which involves 3 specific calls with the sellers. Walk us through each of these calls and explain how this approach differs from what you're seeing in traditional marketplaces that are active in the US, platforms like FP Transitions, for instance.
And I would say, Sam, that not everyone's a seller, right? Sometimes it's a scary word. It's more of a sunsetter, or what am I going to do in my third act? And FP Transitions does a terrific job. They are the big behemoths in the space. They've been around for 25 years. They are excellent at what they do. The difference between BuyAUM and some of those other firms is that I think what we do best is we listen, which is kind of a cheesy answer. But when you look at what we do, we spend 4 to 6 hours with a sunsetter before any introductions are made. The first call of the vision casting process is all about the true value report. It's a free valuation of the practice. It's not a rifle shot, but it takes you from looking at like a mountainscape to binoculars. It goes from, I have no idea what my practice is worth, to here's a range, right? So the first call is all about, we call it the TVR, the true value report call. Where's your business? How many assistants do you have? What's your revenue? What fees are you charging? Are you doing financial planning? What's your story? Have you been in this business for 50 years? Is this a second career? Take me from Genesis to today on your practice. I'm not getting into show me your financials, all of that stuff. We don't do something, and this is a business model risk that we actively engage with, which is we're not asking people to sign exclusivity. We're not asking people to pay us a monthly retainer from a sell side. This is purely concierge value driven. And does that mean that some folks do 2 or 3 of the calls and then say, actually, the guy down the street is a good transition partner for me, I'm going to go work? That's totally fine, right? Not the best business model. It's a risk that we take, but it allows us to be super authentic and transparent in these conversations. So the first call is all about, tell me about your business, how it functions today. Second call is the legacy matchmaker. Sam, when you think about your legacy, your practice, who do you want to transition it to? Are they geographically located near you? Does that not matter? Do they align on investment philosophy, or does that not matter? Like all of these things, no, not numbers or deals, but when you think about who you're passing the baton to of your legacy, which is the biggest thing that a lot of these guys and girls, what they're most careful in transitioning, right? I don't want to pass these relationships off to just anybody or the highest bidder. It's who does that person look like, act like? One of the questions I love asking is, let's say, Sam, that you found the perfect transition partner. You've done a deal that you love, and you're introducing them to your top 2 or 3 clients. What are some of the things that you're bragging about this person? Oh, they've got a perfect track record, or they've got a clean like, let's put yourself in that future state. What do you like about it? So it pulls out of these guys, what are you really looking for? And the reason this is helpful is because usually it's just a thought in their back of their mind that they haven't taken action with. And so these calls are meant to be very slow and methodical. Some of our advisors go, usually I'm the one asking these questions. I feel like I'm in the therapy chair, but it's helpful because it helps them think about stuff they haven't spent the time thinking about. And the third call is all structuring the deal. How do you want to get paid? Do you want to get paid in a lump sum? Do you realize that that's more risk for the buyer? So it's probably going to be a smaller number. Do you want to get paid over 2 or 3 years? Are taxes important? All of that stuff, so that by the end of it, you have what we call a succession blueprint. This is the rough value of my practice and how it's structured and ways I can improve it. Here's what I'm looking for in a succession partner: style, size, location. And then here's a deal that I would say yes to. I want to get paid 50% up front, 25% in month 13, and the other 25% in month 25, and then I'm out. Whatever that looks like. So it's structured so that by the end of it, the sunsetter goes, I know what I'm looking for. I know what I would say yes to. And more importantly, I know what I don't want. So they're not spending time going on dates, as we call it, with buyers or succession partners that aren't a fit and really just a waste of time.
A quick pause. Let me tell you where to go if this conversation is resonating. Leaders don't fail because of uncertainty. They fail because they wait for certainty. At theuncertaintyedge.com, I help senior leaders cut through that paralysis. Free newsletter, free decision tools. And if you want to bring this work into your organization, you can learn more about my speaking and advisory services there too. www.theuncertaintyedge.com. Everything in one place. All right, back to our episode. Now, the dating analogy is interesting because I think in all of these things, what you've gone through is, call it an ideal process, an ideal outcome, an ideal buyer. How are you getting the sunsetters, as you call them, to think through the inevitable trade-offs that are going to come, and how do they choose between these different features? That in one case, the deal structure might be that you get more upfront but less money, or that the buyer isn't perfect. There are obviously trade-offs in any kind of situation that you're going to get through, and the sunsetter doesn't know what those trade-offs are going to be beforehand. But in my mind, at least, it's important that they understand which levers they're willing to tweak and which ones they're not.
I mean, it is very much up to the seller. They are the ones that are picking who takes them to the prom, and they get to choose. Do I want a tall guy or a short guy? Do I want a black limo or a white limo? Do I want sushi or do I want to go to steak before the prom? So how do we help them get there? We ask sometimes tough questions that no one else is asking them, and we do a lot of hypothetical scenarios. Okay, hypothetically, blah, 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 blah. How would you feel about that versus this other one? And so it really depends on what they're looking for. We've got a gentleman that he's done really well for himself over the last 30 or 40 years. It's not about the money. It's all about a perfect match between his style, his way of communicating with clients, and who he wants to take over. He's like, I would take, no, he's not going to take pennies on the dollar, but if it's a dollar with a bad fit or 75 cents with a great fit, he's going for 70. Some other gentleman, I want top deal, and I want top dollar. I want it geographically located to where I'm at, and I want it done in the next 6 months. Okay, so it really depends what their life situation is. Frankly, that's why the model of not pushing them into exclusivity on 6 month or a 12-month, I would be really struggle, because I'm like, hey, we've got 9 months left in our exclusivity of representing you. You got to get a deal done. Maybe he's 2 years out, right? And so it's very much like, look, we're not asking you to pay us. We're not asking you to be exclusive with you. We are truly here to serve you with information. So what I ask of you, the seller or sunsetter, is to show up with effort and to really jump into the pool and say, what would this look like? There's a gentleman in Texas, older guy, 74, lower market practice. We went through all three x-ray or the vision casting calls with him. We got to the end of it and he said, guys, I really appreciate the time. I'm not ready to do anything. And in fact, I'm not even ready to dip my toes in the pool. I want to pause. And it's like, totally fine, sir. Like, we're here to serve you. So it really depends, Sam, on what folks are looking for in their current situation, from timing, deal structure, all of that. We're here to be the kind of the expert resource of saying, if this, then that, over and over and over again, that helps them really say, that I like, and this I don't like. And by the end of it, they know the deal type of person and really who they want to take over. So that, I mean, we had a gentleman go on a first date with a buyer. I don't want to say they fell in love, but they got a deal done very quickly. And after that one lunch, it was like, I love this guy. He's great. He's exactly what the seller said. Is another Texas one. Said, Andrew, it was a lot easier than I thought it would be. I'm like, perfect, right? And it's all because we took the time with that gentleman to say, what are you really looking for and what's important? And conversely, what's not important, right? And that's very different for everyone out there of what's important and what they really don't care about.
Yeah, that makes sense. I think having that, it's very similar to what an advisor goes through in bringing on a client, is what's important, what's not. The more detailed and complete the discovery process can be with the prospective client, the better the relationship is going to be.
Exactly.
I think, so you've talked about, in effect, your discovery process, these 3 calls in that vision process. So walk us through what happens after that. So you've done these 3 calls, the sunsetter is still keen to go forward with you. What makes your process work, and how does it align with, I guess, that discovery that you've identified of what exactly the sunsetter is looking for?
At the root of all of this, it's efficiency of time. Seller fatigue is real. It's kind of like Zoom fatigue. If you're on 8 Zooms in one day, you're
Yeah.
exhausted. It's like, have I done anything? That's very real. And so the whole point of this, I audited our numbers in May, and we've had a lot of introductions since then. But in May, it was 86% of the introductions that we made moved forward to, let's call it a second date. I like him, he likes me, etc. That is because we spend the time to figure out, Sam, what are you looking for? What's a deal you would say yes to? All of those things in the discovery process, that when that introduction is made, there's a match, right? What we don't do is take all of that information and blast it to 10,000 people, every RIA in the country that's over $1 billion, and say, hey, we got it. It is two, no more than three introductions that we make for a sunsetter of really people that we feel like they align with. And if they say, look, really what's important to me is we're working with someone that's in Georgia. What's really important to me is that the buyer is in Georgia. I've got a lot of historically Southern clients. I
Mm-hmm.
want them to be handed off. And we said, I'm going to be honest with you. We don't currently have a premium buyer that is in the state of Georgia specifically. So let's pause. I'm going to go find an interview. We do the same thing with buyers. We'll spend 2 or 3 hours getting really granular so that when we make the introduction, they're vetted, they're compliant, and there's a good match there, right? So it looks like at the end of that process, and we asked our sunsetters, Sam, would you trust us enough to make an introduction? And they don't have to say yes. Most of the times, every time they say yes, because, hey, we've spent 5 hours together. You guys know what I'm looking for. Sure, make an introduction. And so then we'll put them on 2 or 3 dates, whether it's Zoom or in person, depending on what their preference is. It's the beer test. Would I have a second beer with this person? Do I
Mm-hmm.
like them? Do I get a weird feeling in my stomach, or do I kind of feel at peace about it? From there, maybe a second or third meeting. What we do after that, if both the buyer and the seller say, I like this person, I want to kind of go exclusive with them, the buyers will send an indication of interest letter to the seller. It's non-binding, but it says, give me 45 days exclusivity, or maybe 60, whatever they decide to. But typically it's 45 days. I'll sign NDAs. Here's a Dropbox links. Give me the data to do an actual
Right.
vetted, detailed valuation. Great. Sam, I love your practice. Here's the multiple I would pay on it. Here's an official LOI. Let's get a deal done. Let's talk structure, another 45 days or so, and then closing. So it's the design is to have all of the work on the front end with my partner, Reza, and I. What are you looking for? All of that stuff, so that by the time that the introductions are made, they're both a good fit. I like B better than A. And often we'll have not internal bets, but when we're making an introduction, we go, I think he's really going to like A, but we'll set him up with B and C too. And then the seller is like, I loved B. I didn't really like A. It's like, it's
I
great.
got
So
that one wrong.
we like to keep it limited so that there's not seller fatigue. But we're working with a gentleman in the New England area who came to us with 4 LOIs on the table.
Hmm.
And halfway through our process, we said, okay, well, Sam, let me be frank with you. Like, why are we even doing this? You got 4 offers on the table. Well, they don't have this, and I sent an email wanting that, and then it's like they didn't hear me, and blah 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 blah. And so I said, so you really have no LOIs on the table? He's like, yeah, I really don't. And so that's the difference, right? You might have 4 or 5 deals, but none of them are the deal or
Right.
the partner. And so that's really the point of this is let's have some therapy sessions where we're asking tough questions, get to the root of what you're looking for, what matters and doesn't, so that when you do get the next LOI, it's the deal, it's the partner. And from there, everything can go really fast.
And just for clarification to the audience, you guys don't get involved. Your role is matchmaker, for lack of a better word. You connect buyer and seller or potential buyers that fit the criteria to the sunsetter, make the introduction, and then you step back, right? That it's up to the two partners to figure out Is there a connection? Is there not? What does the deal look like in terms of valuation, in terms of deal structure, all of those kind of things? You're no longer involved on either side in terms of moving that deal forward towards a conclusion. Is that fair?
Yes and no, right? We are not the ones putting pen to paper for the valuation because at the end of the day, we've gotten you from the view of the horizon to binoculars, but we're not the ones getting married, to keep with the dating analogy. Some buyers do valuations based purely on EBITDA, and that's the way they do it. Other folks say, I'm going to do top line, but I'm going to normalize your fee schedule from a crazy 2%
Right.
down to 1%, right? So every buyer is a little bit different in how they do the valuations. I don't want to get involved in that because I'm not taking a loan out. I'm not getting married, right? What we do is we stay involved from a let's keep the parties moving together. Let's set up calls. How did you feel about meeting them? It's all the back channeling stuff. So it's not that we get out of the car completely, but we move from the passenger seat to the back seat. And now the buyer and seller are in the front seats, right? So that's kind of our desire. We don't disappear entirely. Even through transition, it's like, okay, now they've done a deal and seller is introducing everyone to the new buyer. We might help with some language. Hey, here's a deck from the buyer. Why don't you share that with your, like, we're here to be of assistance that it's a successful transition on both sides. What we don't do, Sam, is we say, now don't you contact that seller without us on the call. You better. It's not hyper controlling. So the main piece is getting the parties to, yes, let's go into deeper due diligence.
Mm-hmm.
We do step back. We do not get out of the car because at the end of the day, success is a transaction deal done. The seller gets to go to Greece and go on a Viking cruise without having to worry about his phone. And the buyer has brought new assets onto their platform. So we stay involved in an attempt to help proceed forward, but not to be overbearing.
Now, and to clarify, so you've interviewed the sunsetters, the sellers, you've interviewed the buyers, you made the connection, but you're compensated by buyers and yet serve the sellers, which creates an interesting dynamic.
It is.
How do you navigate potential conflicts of interest? And I guess a seller would ask the question, how come they have the freedom to work outside your buyer's network when you're going to all this work?
Yes, it is, as I said in the beginning, it is a calculated business model risk to say, I'm not going to force you into exclusivity. Let's get to a point where we trust each other. It also puts the onus on us to believe, hey, I think we can bring a great match to you. If you find a better one down the street, it's your business, it's your life, it's your retirement. I'm not going to control you to force you to sell to one of our buyers. But I believe in what we're doing. I believe I can bring somebody to the table that you're going to really like. Yes. Are the buyers compensating us? It's a double-edged sword, right? No, the seller's not paying us. We're not asking them to be exclusive. We're not asking them to give us a piece from their pocket. Other of the big platforms, they say, I'm going to take, 4% from both sides or 3% from both sides, right? So I'm really the middleman. I got exclusivity. I set the price. Both people come, I take a piece. We say, let's make it a little bit better, right? Let's have the buyers pay us so that we can truly serve sellers without an obligation of a time in which we're exclusive, without them thinking, okay, they're going to reach into my pocket one of these days and ask me to fork over some money. But the other side of that sword is, well, the buyers are your clients, right?
Right.
So let me ask you, it's like, without preparing for your show, without bringing guests on that you truly vet, interview, and think would bring value to your show, like, I'm not your client, your listeners are your clients, right? But without putting time in to ask me questions, you can't serve your listeners. And it's the same sort of way. It's like, without truly serving sunsetters and sellers and bringing them what they want, we cannot serve buyers. So we say, yes, we serve buyers by serving sellers. And it's been very successful. It's resulted in an authentic relationship with the sunsetters where they like that we're not asking them to pay us $1,000 a month to be on their platform. They like that we're not on the clock to push them towards a transaction. And we're very transparent and upfront with them. Look, the first call, we say, we're not going to ask you for money because the buyer is compensating us if a transaction happens. And it hasn't led to really conflict of interest because at the end of the day, it's a calculated risk that we took. And if someone says, thanks for the time, I
Hmm.
found someone down the street at my country club that's going to buy it, Godspeed to you. And that's the way that we like to do it. I think the root of this is authentic service is really what we're going for. And if I spend 5 or 6 hours hearing about a seller, he's coming engaged and bringing effort. I'm very confident that I can bring someone at least that is going to say, that's a pretty good option for me. Country club guy might be, I have a longer relationship with him, but this is also worth my time and effort to see, is this a better fit? So, it's a long answer, but that's how to sum it up is that yes, we do serve buyers. We serve buyers by truly serving sellers.
And I think to your point, as you were talking, the fact that you're giving indications of value, you're talking about deal structure, but you're not imposing any of that on the transaction, I think removes potential areas for conflict of interest, because beyond the fact that, okay, yeah, you're not getting compensated by the sunsetters and you're getting compensated by the buyers, but it's not depending on what valuation that they agree, and it's not depending on what the deal structure or any other things that are where the typical conflicts of interest occur, that you're pushing for a different valuation or different structure that may not be in the interest of the sellers, right?
Exactly. Exactly. It's service first, right? There's other firms out there, like I said, unless we net $1 million, we're not going to work on the deal. Other firms, it's like if our fee's going to be this high, but then you decide, actually, I don't want to sell the whole firm. I only want to sell a minority interest. I want to sell 25% of the revenue on our firm to an aggregator, keep running the business. Some other firms would say, oh, well, our fee just got cut by 25 or 75%. So I'm going to pass you off to one of the interns, one of the grunts, and you're never going to get the management.
Right.
None of that exists, right? So I think it really is a 1 or 3% better way to structure it. It is different, but we've found there's a lot of reception to it because there's really not any strings attached. You could get a free valuation and get some knowledge and then say, we're working with a guy who's 39 years old. He's in the Midwest area. He's got 140 million under management. You think 39 years old is not a seller, right? He's looking for a transition partner.
Right.
He's the guy that just he's going to now be SEC audited, doesn't really want to deal with all of that, wants to find a transition partner that's going to take a minority stake in his business. That's totally cool with us.
Now, so you can and are serving sellers and buyers in across the US and also across Canada, right?
Yeah, correct.
So for our listeners, Andrew, who might be in that target demographic, the solo advisors or the smaller practices under, call it $250 million, and who are thinking about succession, what are a few things that they can do right now to prepare for a successful transition down the road?
Two actionable things, I think. One, we're doing a deal right now where that's in due diligence. Buyer just got the data room of the seller, all of his client list and all of that. And he looks through and he goes, this is a pretty old book. Now, you would say, well, it's a sunsetter, so obviously his clients are going to be older, right? But there's no relationship to the next generation. Even small 50,000, right? It's staggering. It's in the 70s. I won't specifically say the number, but it's some 75, 74, something like that. Of one spouse dies and assets leave the advisor. And it's like in the 90s of both spouses die, assets leave the advisor because there isn't that next generation.
Right.
So the first most important thing that you could do to increase your valuation or just get your pressure washing your house, right, the curb appeal, is to bridge the gap to the next generation. The kids of your big clients, especially your top clients, top 10 clients, have the conversation of getting to know the children, whether they have an account open or not. Make sure that there's a relationship there because that's a very real risk. It's inevitable that as you are thinking about retirement, your clients are probably 65 plus. A big way to mitigate that risk is go, nope, I know all of the next gen of my top 10 or 15 clients, right? The second is, which people would have, sunsetters typically will have a lifestyle practice, meaning I'm not trying to build enterprise value here. It's paying my bills. Totally fair. Normalized fees to industry standard and average is a second way that you can prepare yourself. So if some of your fees are super high meaning 1.5%, 2%, or they're super low, right? Oh, we only charge 40 basis points or 50 basis points blended. Normalizing that towards to the, 80 to 100 basis points
The average,
is
yeah.
going to help down the road because you're not going to have to adjust up or down. It's how it's currently set up. So those are the two things that I think are ways that you could actively improve the practice as it is today.
I
Two
think
additional, yeah, go ahead.
Sorry, I was going to say, I think that's very valuable. I think you're reminding coming back to that, call it a house, selling a house analogy. I think the advisor is well positioned, should be putting themselves into the shoes of the buyer. Like, not what did
Yes.
you use the house for? What did you use this room for? How did you use the backyard? What is the potential buyer going to want to do with this house? And how best can you prepare and position it with that potential buyer in mind? And you're bringing that kind of mindset as what you're saying with those recommendations. You're bringing that mindset into an advisory practice to
Yeah.
say, it's your lifestyle practice. That's great. This has done work for you for 20 years, 30 years, 40 years. But remember, you're trying to sell a going concern or a business that makes sense to the buyer,
Yeah.
for what they're looking for, et cetera. So make sure that you are positioning it accordingly, right? Or preparing it
If
accordingly.
if you want best in class value or
Correct.
top, right? If you really don't care, then okay, right? But when I value your book, I'm going to say, okay, you got a million five in revenue, but you're charging 2% or 1.5. So I'm going to discount that to what industry average is. Let's call it a flat 1% on your book. So that's going to be the number I use for revenue. Plus, all of your clients are relatively old and you don't have, so that's going to be a negative against your
Yep.
multiple. So here's your new number, right? If that's fine and you don't really care, it's just gravy, then leave it as it is. But if it's like, how do I improve it so that I'm selling for a new high in the neighborhood, to keep with the example, those are two really easy ways
No,
to do it.
that's a great point. So, Andrew, we're coming to the end of our podcast. So I have a couple of rapid fire questions for you that I ask all of my guests. So if
Okay.
you're ready,
Yeah, hit me with them.
number one, professionally, what is the most important lesson you've learned over the years?
I would say don't look for the elevator. Meaning, a lot of people in business and entrepreneurship spend a lot of time on the ground floor looking for the elevator that takes them to the next level. It's find the set of stairs and go up one stair a week consistently. So I think too many people spend time looking for the elevator and not walking up the stairs.
That's great. Yeah, the shortcut. There is no
Right.
shortcuts to on many things, anything that's worth having or learning or doing. So that's a great tip. What is one other piece of practical advice you would offer listeners keen on applying your insights, whether it's as being an entrepreneur or in terms of the service that you're offering?
In terms of an entrepreneur, I have started many businesses in my life career. I was the kid that had the mow the grass company. I mean, I've wanted to do everything. First business I ever started was a tow truck business because I ran the numbers. I'm like, wow, one tow truck can generate. Piece for entrepreneurship, I would say, is find a running mate. And it's a term that I've taken from the Vault conference, but a running mate is something that's very important. It's a partnership. It's more than just a coworker. If you want to start a business, find someone that can push and drive you and you can do to them equally. There's a lot of value in finding a running mate. And then just I think in life, like as I tell my wife often, like wiggle your toes. I think too often in life we're waiting, and I was this way as a kid. When's the next fall break or Christmas break or when's the next birthday or like we're always waiting for the next thing. We're transient, right? We're in between point A and point B, and we just can't wait to get to point B. And so I think for life, it's wiggle your toes and kind of be present in where you are, whether it's you just had you just closed a big client or grandkids came over, whatever it is. I think too often in life we're rushing to point B, and we could all wiggle our toes a little bit more.
That's great too. You're absolutely right, especially in a profession like ours where it's a
Yeah.
very type A, you're building, it's always the next meeting, the next client, the next deal, etc. So that's very good advice. Andrew, this has been a great discussion. If listeners want to learn more about you or BuyAUM, where should they go?
Yeah, so BuyAUM.com. We've got a ton of resources for transition sunsetters, 15 or 20 articles that I've written all about. Our most popular one is RAA valuations, mistakes that people make. There's a ton of resources on there, and I made sure that they have the click to listen feature, because if it's 7 pages, give it to me in my ears while I'm taking a walk or something. So that's on there. And then also on the website is the free True Value Report. You put in 8 or 10 questions. What's your AUM? How much do you charge? And we'll create a valuation for you. We'll hop on a Google Meet or a Zoom and walk through it with everybody. So just BuyAUM.com is probably the best resource.
Awesome. Andrew, thank you for joining us today on the Uncertainty Edge podcast. In this episode of the Uncertainty Edge podcast, I spoke with Andrew Muroli, co-founder of BuyAUM, about why most financial advisors fail to plan their own succession and how a relationship-first approach can transform one of the most uncertain transitions in an advisor's career. Here are my 3 key takeaways. Number 1, the 75% regret problem. Andrew shared a striking statistic. 75% of sellers across all industries regret their transition a year later, not because of the deal terms, but because they never planned what comes next. As advisors, we help clients think through retirement identity and purpose, yet we often skip this step ourselves. This uncertainty isn't just about finding a buyer. It's about answering, who am I when I'm no longer doing this 50 hours a week? True succession planning requires both business strategy and personal vision. Number 2, diagnosis before deal making. Andrew's firm spends 4 to 6 hours with sellers before making any introductions. 3 deliberate calls to uncover what truly matters. This isn't about blasting a practice to thousands of buyers. It's about diagnosing the right fit, the legacy priorities, deal structure preferences, and non-negotiables. By front-loading this discovery work, they achieve an 86% second meeting rate. The lesson? Clarity in what you want eliminates wasted time and seller fatigue. Rushing to go without proper diagnosis leads to mismatched deals and regret. Number 3, positioning for value. When it's time to sell, advisors often think about what the practice meant to them, but buyers care about what it can become. Andrew emphasized 2 actionable steps. Build relationships with the next generation of your top clients' families, and normalize your fee structure to industry averages. These aren't just cosmetic fixes. They're strategic moves that reduce buyer risk and increase valuation. The best transitions happen when you prepared your practice not for how you used it, but for how someone else will build on it. Andrew reminds us that succession isn't just a transaction. It's a transition that demands the same thoughtful planning that we give our clients. Advisors who master this uncertainty don't just exit well, they graduate to their next chapter with clarity and confidence. Thanks for listening to this episode of The Uncertainty Edge. If today's conversation sparked something, subscribe to the podcast so you don't miss an episode. You'll get practical tools, deeper insights, and new episodes every other Tuesday. Please leave a review wherever you get your podcasts. And you can also subscribe to the newsletter at theuncertaintyedge.com for more insights. When certainty isn't coming, your edge is knowing how you move forward anyways.